Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe. Let's talk about the accounting cycle. At the end of the lesson, you should be able to describe the accounting cycle. We're going to begin by looking at the definition. A business prepares financial statements at the end of each financial year so that the users of accounting information can access it to make better financial decisions. There is a process that is undertaken in order to complete financial statements, and this is known as the accounting cycle. So therefore, a definition of accounting cycle is the sequence of events and processes that are used to develop the financial records of a business. We're now going to look at a diagram of the accounting cycle. The basic accounting cycle is a 6-step process. The first step is to gather your source documents. Having gathered that information, what do you do with it? You're now going to classify it and do your journalizing. After journalizing, your next step is to post to the ledgers. Having posted to the ledgers, your next step is to prepare the trial balance. Having done the trial balance, you're going to move on to stage 5, which is adjustments and closing entries. And once that is done, it means that you're ready for the final stage, which is preparing financial statements. So that is the process in preparing the financial statements each year. And once the next financial year begins, then the accounting cycle will restart. And just to recap, the basic accounting cycle is a 6-step process. We're now going to zero in and take a look at each stage of the accounting cycle by looking at stage 1 first, and that is source document. This represents documents from which accounting statements are prepared, for example, receipts and invoices. There are also credit notes, debit notes, etc. Now, let's look at a few examples of receipt. Here we have a cash receipt, and the information that you would pull from the cash receipt there in order to do the next stage would be the amount. If you look on it, you're realizing that it's the method of payment is cash. That information is important because that aids in classifying the transaction so you can move into doing your journalizing. We also have another copy of a receipt that you will be used to, and here we go with that copy. So you're seeing the name of the organization, the amount, etc. Oftentimes we're used to getting receipts like this, and from the business end, as the accountant, you should know which information to pull from that in order to do your journalizing. And here is another example of a receipt. You will learn more about preparing source documents, extracting information from source documents when you move into your lesson on books of original entry. Now what we're going to do is to take a close look at the next step of the accounting cycle, which is journalizing. From the source documents that you have gathered, there may be credit sales, credit purchases, cash sales, cash purchases, sales returns. There may be fixed asset purchase on credit or sold on credit, etc. You're going to classify those transactions. Having classified them, you're going to record them in the respective book of original entry. For example, sales day book, you'd put your credit sales there. Purchases day book, you put your credit purchases there, etc. Now, again, once you move into your content on books of original entry, you will zero in on these. Now, these books of original entry, they basically carry rows and columns, and you would record in these based on accounting principles. Now, here are two examples. We have the cash book And we also have the general journal. We move into the other stage of the accounting cycle, and that is posting to ledgers. What you're doing is transferring all debit and credit entries from the books of original entry to the ledger using the double entry principle. That is, for every debit, there must be a corresponding credit. And to achieve this, you'll be guided by some double entry rules. Now, in preparing ledger accounts, you're doing basically T accounts, and here's an example of a T account, that is a capital account. The T is represented in red. The left hand side there is a debit side, and the right hand side is the credit side. In order to debit and credit again, you would use the double entry rules to get that done based on the transaction. Step 4 is preparing the trial balance. That is making a list of all debit and credit balances brought down from the ledger in order to check the arithmetical accuracy of the ledgers. The trial balance is a part of the control system. What you're basically doing is checking if for every debit there is a corresponding credit. You're also checking for any mathematical error. You're also checking to see if there is any overstated value or any understated value, etc. Okay, so here is an example of a trial balance. You have the name of the business, the type of document you prepare. You're seeing a list of accounts and their balances. The balances are taken from the respective ledger accounts, and if it is a debit balance, you'll use the debit column. If it's credit balance, you would use the credit column, and at the end of it, you would then total. We're now going to look at stage 5, and that is adjustments and closing entries. According to the accounting principles, adjustments must be made to certain accounts to allow for all owings. So if there is an expense, for example, that the business is owing for, the account would have to be adjusted. Prepayments, which are the advances, discounts, and depreciation, before the final accounts are prepared. So those adjustments must be made to the respective accounts. We now look at the next stage, which is the final stage, and that is preparing financial statements. In this stage, what you're doing is preparing income statements, statements of financial position, cash flows, etc., at least annually, to judge how well a business has performed, so that the owners, managers, and other stakeholders, if you have missed that lesson on users of accounting information, the link is in the description below, can make key decisions about the future of the business. Let's look at 2 examples of financial statements. Here we have the trading profit and loss account, which is the very same thing as the income statement. The aim of it is to determine whether the business has made a profit or a loss. We have the balance sheet, and basically that shows the asset of the business, the liabilities, and the capital. In summarizing today's lesson, do remember that the basic accounting cycle is a 6-step process. It begins by gathering your receipts, your invoices, your credit notes, etc. So that's your source documents. Once you have those, your next step is to journalize. In journalizing, you're grouping the transactions and recording them in their respective book of original entry. Once that is done, your next step is posting to the ledgers, and in this step, you're ensuring that for every debit entry, there is a corresponding credit entry, and you're guided by the double entry rules. Following that, after balancing off, your next step is to do your trial balance. At this stage, you're making a list of all the accounts along with their balances in order to check the arithmetical accuracy of the ledgers. Once that is done, you then do your adjustments and your closing entries. So you're adjusting for depreciation, accruals, prepayments, provision for bad debts, etc. And once you're finished with that stage, you can then move on to preparing your financial statements. And when the next accounting period begins, the accounting cycle will restart. And that takes us to the end of our lesson for today on the accounting cycle. Like, share, and don't forget to subscribe.